Hello everyone, this is Sebastian Beckman from IA Financial Group, and I'm back with the weekly economic review for the week ending December 12, 2025. So this is the second to last review of the year. Next week on December 19, we will wrap up the year, but mostly look forward to 2026. So don't miss this one. It's going to be where we share our views for the next year. After that, we will be off for 2 weeks, not 2 years, during the holidays, and be back next year on the first Friday after the first full week of the year. So this week we're looking at central bank action because we had the Bank of Canada and the Fed with their decisions on Wednesday. Very different vibe from each, so we'll dig into that. But before we do, let's look at this week's markets at the close on a Thursday. We're almost done with the year here, so this is all close to a photo finish here. Bonds, fixed income positive on the week for the year. Slight gain in corps, about 4%. Slight gain of 2.3% for the universe index, but the long index was negative. For equities, the crown goes to the TSX, 31% on the year if it was to end now. Second place would go in Canadian dollars to emerging markets. After that, AFI, and then after that to the US. And of course, the US did still post exceptional results this year. If you look at the local currency indices, 19% for the S&P 500, 23% for the NASDAQ, and this is following a few very solid years of 25% plus returns on the NASDAQ. So still very, very hot, but our recommendation at the beginning of the year turned out to have been right. We recommended to stay overweight equities, stay with a core holding in the US, but be overweight global ex-US, favoring Canada, favoring Europe, favoring emerging markets. So this is what you got this year, and we're looking at the continuation of these themes in 2026. So we're still recommend to stay overweight equities. We still prefer global ex-US, but keep an exposure to tech and AI in the US. I'm starting to spoil a few of the views from next week, but what we're seeing here is in line with what we're expecting moving forward. The real star of the year, though, was gold. We've been fortunate to be well positioned in gold throughout most of the year. 63% return in 2026. We could still have some very good returns from gold. It depends on how geopolitics, how markets, liquidity, how the view on the US dollar turn out. But there's still reasons to like gold in 2026. But as of right now, we do not hold any gold in our discretionary book, and we'll keep you posted if our views change there. So this is the picture of a very interesting year, very surprising year given everything that's been going on through the last 12 months. Now, looking at the stories of the week. So first, the Bank of Canada stays on the sidelines. We're at 225. This is at the bottom end of the neutral range, so there's optionality. If we see a weakening of the Canadian economy, the bank can still cut by about 2% until it reaches the low point of 0.25. If the Canadian economy surprises to the upside, then it can start moving higher without really bringing too much restriction on the Canadian economy, because there's still some room within the neutral range. So the Bank of Canada is in a very nice spot with inflation that's looking pretty much under control. Mr. McClem said that the economy is proving resilient overall. Of course, the USMCA has been very beneficial to the Canadian economy, shielded the Canadian economy in 2025. Of course, there are some sectors and some regions that are hard hit by the tariffs, but globally, Canadian economy is doing well, and the bank believes that the benchmark is at about the right level to keep inflation close to 2% target. So this is bank speak for rates are not about to move anytime soon. So we are optimistic about 2026. There will be some noise from USMCA, the USMCA renewal. This is in Mr. Trump's nature to try to get the best deal possible and just, throw a few things at us here. But overall, we think that the momentum is good enough. The lower rates will be helping consumers. So there are a few good things to like here. So we tend to be on the optimistic side, and maybe the next move is not a cut, it's a hike. More on that in a few minutes. Looking at the Fed now, market expectations on the right are that they will be cutting slowly. The dots that you see there are the FOMC stake, and they think that they will be cutting slowly as well. So we just had a third consecutive cut on the year, but likely starting from here, there will be a slower pace of cuts ahead. So it was not a unanimous vote, 9-3. Two dissents were for no cuts. One dissent, of course, Stephen Maron, voting for a 50 basis points cut to please the president. But we still did get a cut. But looking towards 2026, Mr. Powell was trying to sound very neutral and balanced, but he was putting so much emphasis on the weakness of the labor market that he did come off as dovish. But the market, let's see over the next week or two when we get a few more Fed speakers, how it reacts to all of that. Now, Mr. Trump was opining during Mr. Powell's press conference that the Fed could have at least double the interest rate cut, and even asked out loud why can't the U.S. have 20-25% GDP growth in a year. If anyone wants to take that question, then send him their take on the answer. Feel free to do so, but of course it's not likely to happen anytime soon, and at least not in real terms, in nominal terms. If you want to cut rates to zero and just inflate the economy, you can have very solid nominal growth, but real growth, that's a very different thing here. But I digress here. So for the US, this is what we have. Now looking at market expectations for 2026, two tables on the left. As you can see, the market is expecting more rate cuts as we move forward, maybe two by the end of 2026. But you see there's lots of dispersion for the Fed on the left. On the right, Bank of Canada staying still until next fall, and then in October, more likely than not that we will have at least one hike. This is far in the future. Many things can happen until then, so we'll see. But we do agree here that the Bank of Canada has optionality, and that things are likely to beat a very, we think, pessimistic consensus now. So it would be reasonable at some point for the bank to start moving in the other direction. But it's not something that we are thinking is imminent here, as does the market, and many things can happen until October, of course. All right, so moving to the last slide here. So markets are thinking that the global cutting cycle is mostly over. And one of the determinant factors behind our outlook for 2026 is that the synchronized cutting that we've seen over the last quarters or even years from major central banks is providing a solid tailwind to the global economic cycle and to the economy, which should lead in 2026, but also maybe go all the way through at least the middle of 2027. So we are constructive on the economic cycle, and we think that we're not in the late innings, where maybe in the early innings or maybe the middle innings of this business cycle. So that's a determining factor, but at some point, this is the nature of economic cycles. If central banks stimulate the economy with accommodative monetary policy, at some point they will have to start hiking because inflationary pressures will come. This is the nature of economic cycles, and markets are thinking that we're getting towards that point where now maybe central banks will have to start hiking again. So we're thinking about an impact that should hit the global economy in late 2027, 2028, maybe beyond. So this is the inflection point that we're in now. So this is not something that's immediate in terms of a threat. We still see lots of stimulus in the pipeline, but interesting that we're at this juncture now. So the Bank of England here and the Fed are seen as cutting still for a while before they start hiking, but other central banks, including the Bank of Canada, are seen as candidates to start hiking soon. So what we'll be watching next week week in Canada, CPI report. We'll have the CFIB business barometer. So we've mentioned that often. We want to see Canadian businesses hire and invest again. So very interesting indicator there, and the retail sales indicator. And in the US, we're starting to catch up some of the unpublished data. So October, November non-farm payrolls and unemployment rates will be out next week. S&P Global PMI, so no delay on that one. November CPI report. Of course, there's going to be no October CPI report. They're going to be just extrapolating between the 2 points. And the October retail sales report will be out as well. So don't miss next week's review. This is going to be the outlook for 2026 before 2 weeks off for the holidays, and we'll be back in early January after that. So have a good week. If you enjoy the content here, please make sure that you share, and of course, don't miss next week's edition.